So, how often are accounts manipulated? Well, the answer is all the time. Let me make a safe and totally unscientific assumption. All companies manage earnings all the time. The question is not one of incidence, it is one of degree. This is the unfortunate truth. Companies do manipulate all the time, even if the CEO has the best of intentions, and the tone at the top is ethical and pure. That does not mean that other executives who have decision power are not manipulating in the lower ranks. Yeah. To say that a company has earnings that dollar for dollar are correct and true and are not manipulated is a tall order. There is always some form of manipulation. And this manipulation, I predict, is more than 1%. This manipulation can be both upwards, like inflating earnings, or downwards, like depressing earnings. It can be in both directions, because sometimes executives need to show better numbers than what they really are, and other times they need to lower these numbers. Artificial lowering of the numbers occurs when, for example, you have union negotiations and the employees want more money. You lower your income to show them that you have no money to give. You also want to artificially lower your income if you are under governmental scrutiny for being anti-competitive. Let me make another unscientific supposition. For most companies, reported earnings are within 5% of true earnings. 5% is I can get away with it earnings management. You manipulate 1% from each account, you are almost never caught. Even if you are caught, you are not strongly prosecuted. No one catches you for 5%. But then again, sometimes that 5% is all that you need to get your bonus, or to show an increase in an earnings streak, or to show that revenues are going upwards in a trajectory. On the other hand, 25% manipulation is stupid earnings management, and you risk getting caught. In real life, we often see earnings manipulations that are in the order of magnitude of 10 times higher. 200%, 300%, 500% earnings manipulation. When numbers reported are based on really, really optimistic and far-stretched accounting assumptions. So why do you have sometimes 5% earnings manipulation and sometimes 25%? The variation depends on the CEO and what they want. It also depends on the strength of external monitoring structures. A CEO who really wants these earnings will create them. An auditor really determined to be ethical will prevent them. Why do earnings manipulations exist? Well, they have been existing since the dawn of times. Whenever the owner has an employee, there exists a problem of proper control. The owner cannot 100% monitor the actions of the employees. Hence, unscrupulous behavior. In modern corporations, the problem is more acute. There are many layers of management and thousands of employees. Hence, we need an internal police to make sure things go well. This internal police is called the Department of Internal Control, and it is under the control of the CFO. However, what if the CFO is also crooked, or the CEO is crooked? Then we have a problem. Both the CEO and CFO are employees, have the incentive sometimes to untruthfully report true financial performance. Therefore, we have earnings manipulation. Earnings management is not only at the top of a corporation, like at the CEO or CFO level. It exists within the subunits of the organization everywhere. A division manager manipulates towards central headquarters. Various departments towards the division manager. Even if the CEO is extremely ethical, he or she would have a good approximation of company profits, but never an exact determination. Internal information reliability depends on the strength of internal controls. 1934 was a beautiful year for accounting. since it marks the year for the start of modern accounting. Let us go a few years before that. The 1920s saw the greatest global recession the world had ever seen until then. A bubble had formed in the New York Stock Exchange, and it was helped by fraud and accounting manipulations. There was neither accounting rules at the time and nor auditing. Companies could really say what they wanted about their own performance and the value of their assets. Hence, a bubble was created, a huge one that crashed in 1929. The crash brought down GDP by 29%, meaning we are spending 30% this year compared to the year before. Such a drop in consumption brought terrible calamities to society. Breadlines, hunger, unemployment, you name it. To solve the mess and to prevent future crashes like that one, President Roosevelt named his friend, Joseph Kennedy, to fix the mess. You probably know Joseph Kennedy. Well, this is the father, not the son, the father of John Kennedy, the president. He was a master market manipulator and insider trader when it was still legal. He had amassed a fortune of about $4 billion in today's money. Kennedy, tasked to fix the mess, became the first head of the Securities and Exchange Commission, which was just created. Starting in the 1933 and 1934 periods, accounting rules are written and formalized, and auditing is mandated by every single publicly traded firms. The rest of the world follows, and so now we have accounting and auditing rules almost everywhere. Of course, with great accounting and auditing, the world is beautiful and perfect since then. Hence, the creation of accounting and auditing rules has been a direct consequence of earnings manipulations and fraud. How do we know that manipulation is common in corporations? Well, we rely on statistics. And statistics never lie, of course. Big sarcastic wink. I'm kidding. Things in life very often follow a normal distribution, where everything is centered around the mean. The length of a telephone call, the height and weight distribution of people, their intelligence. Okay, well, earnings distributions of companies should follow the same pattern. We have the average company in the middle, let us say a 10% return on sales on average. Then you have the highly performing ones, let us say, with a 25% return on sales. Then you also have the extremely successful ones with a return of sales of 40% or more. The same can be observed on the other side of the distribution. Poorly performing companies with a return on sales of -5%. And also the really terrible ones with a return on sales of -20%. This is what we would expect from a normal distribution of company earnings. Well, it seems this is not the case. Company profits are not normal. In fact, they are very abnormal. Earnings seem to have a funny distribution. They are truncated at 0. Then also to the left-hand side, much flatter than the right-hand one. What is happening? It seems that companies do not like to have 0 earnings or slightly negative earnings. If their true performance is 0 or slightly negative, they like to jump to the right-hand side of the distribution. How do they do that? Well, they manipulate. Change an accounting assumption here, change a number there, and hey, you're on the right-hand side of the curve, and you're in the positive territory. Shareholders, employees, suppliers like companies that are in the green. No one wants to do business with losers. Everyone who is on the left-hand side, who has slightly negative earnings, is trying their best to jump to the right side. Yeah, this is quite common, as you see. This is based on data on more than 10,000 companies. And such big data do not lie. It is not only that it is the data, it is common knowledge in the finance world. I had a friend who retired at age 47. He was chief controller and worked right under the CFO. He said he retired as soon as he made enough money to have a nice living. I told him what happened. He said that his boss was too sleazy and he did not like it. He said he would work months preparing the financial data. Then when he would get a phone call from his boss telling him that earnings this quarter have to be $3.42. And then he had to sit down and see what assumptions he could change so that he could report numbers that are $3.42. Of course, this is only one anecdote. I will not make a theory out of one observation. But I have heard this over and over and over and over. It really never ends. The same funny and abnormal graph is also replicated in one form or another for the change in earnings, for cash flows from operations, for the change in cash flows, for the change in sales, and for earnings with respect to analyst forecasts. Companies really hate to miss analyst forecasts. So they have to try their best to beat it, even if by 1 cent at least.